afternoon, everyone. First of all, thank you very much for coming to this talk. I know the interest of times, it is not possible for me to cover whole Asian insurance markets. I will actually focus on further presentations on two markets, which is China and Malaysia. First, I'll just give you a broad overviews about the Asian insurance markets as to what are the outlooks looks like. Fitch has actually assigned outlooks for all this series of insurance markets in Asia. You can see that this is some of the countries, for example, like China or Japan. We have previous year had assigned outlook, and this year's late last year, actually, we actually affirmed the rating for the outlook for that market. And for each of the insurance markets, we actually further break down by the life insurance sectors and the non-life insurance sectors, because each of them have its unique characteristics. What we mean by stable outlook, before I go into details, I just want to highlight. A stable outlook assigned to the sectors itself, it means the likely rating actions which we have already taken into the fundamentals of the companies are likely to be stable. That means all the ratings that are assigned in those sectors, in these markets, are likely to be affirmed between 1 to 2 years. Obviously, this is subject to the trends as within our expectations. If a specific markets have some significant catastrophe exposure or some earthquake losses that are beyond our predictions, sometimes it will change our outlook on that specific markets. In Asia itself, we have covered around 60 plus companies between life and non-life companies. And this is the outlook that we have on those credits as in November 2011. 94% of them are actually on stable outlook and a small percentage on negative itself. We are seeing on the Asian insurance market, the sector improvements are actually peaks. Not saying that it's going to deteriorate, but it has actually improved to a level that we expect it to moderate going forwards. And for a specific market, for example, in Japan, we are all aware that in last year, March 11, Japan had experienced one of the very significant earthquake. And during that times, Fitch has actually taken some rating actions on the non-life insurance companies, where we're putting all of them on rating watch negative. And then subsequently, we stress test those companies, and we believe that at that time, there are sufficient capital buffer to withstand the losses that they might incur. And as it turned out to be, after the few months we reviewed and we actually affirmed those non-life insurance company rating. And for the life sectors itself, we actually seen that their exposure to the cat loss are much less as compared to non-life insurance companies. And we are actually affirmed those credits. And subsequently, as months progress, we also see there are some regulatory changes in the Japanese life sectors, where a lot of Japanese life insurance companies are actually de-risking their portfolio, moving from equities to fixed incomes portfolio. The rationale behind that is because of the new solvency regimes introduced in Japan for all their life and non-life companies, where the associated risk charge with the equities are much higher compared to it was before. And we are seeing that significant movements of these portfolio de-riskings. From a credit perspective, we see that is a positive thing, because we always view that equities to a life insurance companies tend to be a volatile risk that they need to control carefully. And because of that, we actually have gradually taken positive actions on them. And this forms some of the fundamental why, despite the cat losses we've seen in Japan, last year we still actually affirmed a stable outlook for the Japanese life and non-life sectors. So this actually just sharing some of the views on the Japan. But follow that, I actually want to go into more details about these two markets, China, life and non-life sectors, and Malaysia, life and non-life sectors. In China itself, for the life insurance side, we actually have affirmed the stable outlooks for the sectors itself. We see that the ongoing business expansions have actually continued to provide growth, as we've seen in the value of in-force business. I'm aware some of you are not coming from the insurance background. The value of in-force business is a common term actually used within the equity analysts as well as from our credit analyst perspective, is actually look into the possible profits generated from the life insurance companies, and it's actually a present values measure. So this value of in-force business, or rather embedded values, are become a common terms nowadays when one wants you to measure life insurance profits and its values itself. So here you have seen that actually these are the 4 major listed companies, I mean 3, and then Taiping is within a listed group as well. That we are seeing the value of in-force business are actually growing throughout the years, but actually the growth rates for the 2010 to first half 2011 are actually moderate. There are some reasons behind which I've explained before, but at least on the positive side, the value of in-force business are actually growing. But definitely not compared to 2000 or 2009, the growth rate for the value of in-force business are much higher. What is the rationale behind the moderate growth rates of that? Is because there are some new regulation being introduced in 2011 regarding about bancassurance. The regulations itself actually control Chinese banks to distribute the products. Prior to that, Chinese banks can actually having insurance agents market the product to them in the branches, whereas last year there are some regulatory control by CRRC to actually only allow the bank's branch trained insurance professional to sell the products. Obviously, that has certain obstacles in terms of the sales volume coming from bancassurance. And the other thing is related to liquidities, and we're all aware that the Chinese bankings are facing some tightening of bank reserve ratio. I think in last year, July, that time, it was still 23%, but now they actually reduce it, which is good. But before that, the reserve ratio for the banks itself are relatively high. That have actually become a competitions between the banks and insurance companies to actually retain customers within the Chinese banks. We can see that in the sense that life insurance is similar to a bank deposit, especially a single premium insurance product itself. Normally in China, what we see is insurance companies actually getting consumers from the banks who are actually moving from bank deposit and put into a single premium products in order to get a better returns. So the tightening of the liquidity itself has become a partial incentive for Chinese banks to actually retain the policy, retain the customer within the banks, and not that active to sell the life insurance products for their life insurance companies. So these are some of the rationale why we're all hearing the market people saying that bancassurance sales has dropped quite significantly since last year's and the year before. And the other things that we observe is in the life insurance sectors itself, investment exposure for the China life markets is still relatively volatile. Not like some other life insurance company we see in the more mature markets, a lot of the sources of the profits coming from the life insurance products heavily relies on the investment returns. So because of that, the stock market volatilities of the local China stock markets have directly impacts on the earnings of these Chinese life insurers. That's why we are seeing some volatility in that. And the other things that business expansions, although we see that potentially slow growth in the bancassurance side, but there are still, given the economies are growing, we are still seeing there are some potential new business growth coming from the markets itself, where this new business growth actually demand capitalizations. That means that for the business that are underwritten into the book, they will need more capital to support it. And with the business growth, with the economic growth, the China life insurance companies are actually facing some capitalization pressure because they are actually writing more business and they need more capital to support writing all these business within the book itself. So that result in their solvency margins being squeezed. Under that circumstances, we are seeing that various mostly listed companies actually have done quite a series of external funding, what is through sub-debt issues itself. In 2011, the total amount of sub-debt issued by insurance company total around 46 billion yen itself. and that is around 50% of the last 7 years amount of capital issued by all the Chinese life insurance companies. So for one specific year last year, the many Chinese life insurance and non-life companies actually issued a significant amount of sub-debt issuance to support the capitalizations. This is, one can say that this is good because at least they find a way to manage the funding itself. However, the features of the sub-debt issues tend to be very short terms, usually about 10 years, and with a step up of 5 years. That result in every 5 years, these insurance companies will have to find a way to continue to fund the business going forward, which is slightly different from some of the debt issuance that we've seen in Europe or US, where they are much more longer term, and the term itself is perpetual or at least 40 years. But I think that will take time for the changes. Also, the other thing is, given the significant amount of sub-debt issue, we also see that CRRC has immediately taken a measure. Before that, there are actually no strict restriction in terms of the amount of sub-debt actually could be issued by the life or non-life company in China. However, since last year, we've seen that the CRRC had actually tightened up the measure, allowed for the company issue sub-debt. The total amount sub-debt issuance cannot exceed 50% of the net assets itself. So that is again a new measure to control the sub-debt issuance, could potentially force a life insurance company or non-life insurance company to tap into equity markets to raise more funding, because the growth will continue, and that will result in their solvency margin continue to deteriorate, as I show here. You see that for the last few years, the solvency margins for the big players, they are continuing to drop as well. And that is the reason why we always hear in the markets news that life insurance companies, they need capital, and they issue more sub-debts. China Life, for example, last year had actually issued 34 billion sub-debt to actually continue to fund, and this is the first time to fund their growth going forwards. We're seeing that more and more Chinese life insurance companies and non-life companies actually try to tap into the capital markets to raise funds to meet the solvency margin pressure that we've seen. In terms of the non-life itself, I would see that non-life, the underwriting coverage and underwriting profitability has actually peaked since actually had peaks, because if you look at this, combined ratio is actually, the higher the combined ratio, that means the lower profit margin the company has. So what I meant by it peaks is, in 2008, most of the non-life companies in China actually suffer some significant losses, where we see the combined ratio actually more than 100%. But throughout the years, during that time, CRRC have actually introduced a measure to control the fraud claims. Non-life insurance, slightly different from life insurance companies. Non-life insurance companies, the nature of the liability are much shorter tails, and also they are more likely to subject to fraudulent claims. Because for life insurance, a claim is a death claims or a medical claims which can be easily identified. Whereas for a non-life insurance claims, the claims are usually associated with a motor insurance claims, or possibly liability claims, or maybe property fire risk claims, and where there are higher amount of errors or fraudulence involved. That's why in 2008, when we see that the CRRC had actually taken strict measures, because they see the industry sectors, for the non-life sectors, are actually not performing that well, that they have actually introduced some measure in terms of what we call premium before coverage. That means that the companies will have to collect the premium before they give the coverage. Before that, it wasn't like that, because before that, there are many procedures where they can provide the coverage without paying the premiums, and they pay the premium only when the claims has arrived, which is not a common practice outside of China. Whereas the introduction of collection of premiums, then provide the coverage, it is somewhere in a way to control the amount of claims that the company will pay. And that we've seen the improvement on the combined ratio over the last few years itself. The other issue that facing the non-life sectors in China is a compulsory third-party business. This is compulsory, that means it's currently only can be sold although the regulatory changes, the regulation changes, but this at this moment is only available for the domestic companies to provide that. A compulsory third-party business itself, although it's only occupied around 10%, but you can see the losses are quite significant on the charts on the right-hand side as well. You see that in 2009 and 2010, the losses are quite significant, but we are seeing that this year onwards, the CRRC are actually introducing new regulation again that allow foreign players to actually participate in this CTPL itself. Why foreigners are actually interested in? Because foreigners are actually interested not because of CTPL, are more interested because of the motor insurance associated with that. When the person buys a motor insurance, usually they need to buy a CTPL. And having that open up to the foreigners itself will help partially to mitigate the losses of all going to the domestic players. At least the foreign player can share part of it. But also, the motor insurance pricing reform also allow a more established local or foreign players who meet certain criteria to actually adjust their pricing according to their experience, which is in the free markets like outside of China or in a more sophisticated markets itself. That is a common thing that we see. Non-life players are free to adjust their premiums according to the experience. In the past, it wasn't like that in China, but this year we are seeing that CRRC are introducing that, and we could see that that could potentially see some pricing competitions among the motor insurance sector in China. And we say that the other things that what we see in the non-life sectors is premium growth are always similar to life insurance to continue to pressure capitalization itself. So that is a measure we always look at is a net premium leverage itself. That means for $1 of net premium, how much capital you have. In all the non-life companies that in China, their net premium leverage ratio are significantly higher than what we call 1.8 times benchmark. That benchmark is based on Fitch point of view that for A-rated companies, usually the net premium leverage is fixed at 1.8 times. So in order to bring all this high leverage down to 1.8 times, you need about 80 billion. That means that if those companies are to be rated about A-rated, some of the company might need more capital, some of the company might need less, but in total for the whole industries, 80 billion is about the figures that will bring the leverage ratio to a level that to commensurate an A-rated rating. And this is only a guidance. Because as you see behind our methodology approach, we did say that for different net premium leverage, they commensurate to different rating levels. This is based on our experience and based on having that sort of leverage ratio, we'll usually get that rating level. And that is actually indicate that the markets will need to do quite a bit of fundings and maybe readjust their growth in order if they want to rate around A-rated companies. And that means that is quite a high investment grade. And the other things that what we've seen that CRRC had actually, all these are, why we keep mentioning about CRRC is we have a stable outlook on the non-life sectors because we see CRRC actually doing some of the positive things to actually monitor the markets to control the risk itself. The other measures that we see that CRRC have actually introduced is control the business growth according to the solvency margins. Which I try to relate here is that when you write more business under life and non-life business, your solvency margin or your capitalization will tend to be stressed. So under this, I believe CRRC have a similar views that when the solvency margin are highly greater than 150%, the company can write any kind of business. No restrictions are actually introduced. Whereas when the solvency margins itself fall below 100 to 150, these are some of the companies we have seen that actually have some restrictions. Maybe the new business, they have to write within certain growth, and also that for the inadequate one, they could even do not write any more new business. They can only continue to write to run off the existing business itself. And that also partially explains, like PICC itself, why they are very keen to actually bring their solvency margin higher than 150%, which they tend to issue sub-debts and do other measures. Some of the positive things that we've seen that obviously in non-life sectors, where ALM are less of concern because, as I mentioned, non-life industries, the liability tends to be much shorter terms itself, and having a good liquidity is really a good thing. And we see that most of the non-life companies in China actually their exposure to, the asset risk itself is rather minimum. Most of the asset actually put in cash and deposits as compared to their net claim reserve itself. So this conservative asset mix itself make them promptly and able to actually make them able to timely make claim payments whenever necessary itself. So this is really a good thing as compared to some of the non-life companies we've seen in certain markets, such as in Japan as well. We actually see quite a high amount of assets for the non-life companies are actually in equities. So as a cap, I'm going very fast because of the time itself. Here is just what I mentioned, the life insurance sectors, why we have unstable outlooks, and the non-life insurance, basically we see that the growth are still actually continues, but there are actually a pressure on the solvency margins. We see that the sub-debt issuance could be a mitigating factors, but this is really short terms. I think in the long term there will be new type of hybrid capital could be issued, could mitigate that kind of risk itself. For the non-life sector itself, obviously we see the losses in 2008, but that has gradually reduced. We also see that the introductions of the pricing reform on the commercial motor side could potentially enhance the pricing competition itself. Market disciplines out there because of CRRCs, which is the Chinese insurance regulator, has been closely monitor the markets itself. So that share some views about the China with your view. For Malaysia, the life markets itself is completely different. This is another site in Southeast Asia. In Malaysia, life insurance sectors, all the time itself, its growth are actually tied quite tightly with the GDP itself. You can see that the general insurance sectors actually have the growth rates around 9.4%, and whereas for the life insurance sector, the growth rate has actually improving, actually coming from 2008 itself. 2008, there are the Lehman crisis, and that lead to a significant downfall or some of the products sold by the Malaysia Life Insurance Company, but we see that sort of trends have actually recovered. And also the other thing that we see that the Malaysia government had actually quite actively introduced economic transformation programs that actually want to promote the GDP growth of Malaysians from, I believe, US 7,000 to 15,000 in 2010. That is actually try to enhance the Malaysians' earnings in the country itself. And when that happens, usually we will see that corresponding improvements in the life insurance sectors because the personal wealth programs and rather the personal wealth of individuals has actually increased. And as I mentioned, that in the 2008 is times that we will see significant amount of investment-linked products has suffered due to the Lehman crisis and also the stock market volatility. But investors tend to have a short-term memory. It seems that now that investment-linked products are coming back, and a lot of products are actually selling through bank assurance itself. And we are seeing that also the introductions of RBC, risk-based capital concept as a solvency in Malaysia, had actually controlled and streamlined the kind of products offerings in the marketplace. Investment-linked products itself tends to be a less capital-intensive product because it is related to fund management. You actually buy into a product where there are minimum amount of capital required in there because the policyholders or the consumers actually pick the fund that they invest in. So life insurance companies actually have no commitments to generate certain kind of return to meet the guaranteed returns in the normal life insurance products. So investment-linked products actually, given the introduction of RBC, where cost of capital are actually increasing, investment-linked product obviously become the star in the Malaysia life sectors because the capital required is much lower. And also we also seen that the RBC introduction of RBC risk-based capital solvency had actually induced some M&A activities there, where smaller companies are likely to be actually acquired by bigger players. This is slightly just demonstrate to all of you that why we see that Malaysia life insurance is stable, as historically for the last few years, the operating performance tend to be quite benign. Surrender rates, that is where people come and return the policy, surrender the policy and ask for refund, tend to be quite on the low side. And also the total expense ratios are also quite at the moderate side. And for the last 5 years, we don't see a significant increase in them. As Malaysia life insurance, as we say that, they're also exposed to equities, but they're all at the manageable levels. They do not like some of the companies that we've seen. I keep mentioning Japan because Japan actually have issue with equities because they have really huge exposure in that, and that's why, as compared to their peers in the Japanese life insurance, the Malaysia life insurance equity exposure are quite significant at the management level side. Operating margins, where we've seen just now the charts that they consistently has been quite satisfactory level. The expense ratio are pretty stable over the last 5 years as well. And in terms of the risk-based capital adequacy solvency margins, we see that the big one, I would say the top 5 or 10, they are quite adequate as to compare to some of the smaller one. The smaller one, clearly we see some changes where partially due to the changes in the local Malaysian regulations, where foreigners now can actually own up to 100% of the JV, where we are seeing that that also partially induced some M&A activities, such as Manulife had actually acquiring 100% of their branch in Malaysia now. So, and also we see that for the non-life sectors, similarly, we see Sampo Japan actually acquire 100% of the Berjaya Sampo there. So these are some M&A activities related to the change of a foreign ownership in Malaysia, where we see that could gradually, I won't say immediately, gradually change the way how some of the life and non-life companies operate in Malaysia. I would say that would potentially raise the standards, but that could have some pricing competition effect as well. For the non-life sectors itself, the premium growth are primarily driven by the motor sales. As you see that motor sales account for about 50%, whereas fire insurance are a much smaller pie chart, but fire insurance actually is the most profitable line of business we see, and that will continue going forward. And partially of this high profitability is because of the tariffications. In Malaysia, all line of business are actually under the Malaysian tariff rates itself. That means the government determines the rates, whereas the insurance players, they have the opportunity to actually incorporate the expense margin so that to price the product at a certain profit level that which they desire. But we are seeing that over the last few years, clearly the fire claim ratio, that means the losses over the net premium returns, is actually quite low, like 40%. And that means that this is the main line actually driving the profitability of the non-life insurance sectors. And in terms of the motor side, although we say that it's the largest amount of contributor, but we've seen that it's not as profitable. And if you just look at the loss ratio, similar like China itself, the third party's line of business have a huge amount of losses coming, even since 2005. 150%, that means that for $1, this is excluding the expenses. That means this is basically based on the claim itself. For $1 of premium you collected, you are paying out $1.5 of losses, excluding expenses itself. So with that itself, the third parties is actually highly unprofitable. But luckily, third-party liability business is always a small percentage of the total motor business. And for Malaysia, it's around 10%. I think for China, it's about 25% itself. So when you combine with the motor business itself, the overall motor business is still manageable. And plus, just now we mentioned about the fire insurance business, where it's highly profitable. So that makes that Malaysia sectors itself, in terms of the operating performance, are still relatively fine. You can see that under the underwriting margins, underwriting margin percentage itself. That means that throughout the last 5 years, the Malaysian general insurance markets are still making some profits itself at the 7.6% based on the pure underwriting, excluding the investment return that they might get. So overall, I would say that the underwriting margins are pretty consistently favorable, and Malaysia's, keep my finger crossed, is still absent of catastrophe. In Malaysia, they don't have earthquake, they don't have flood, they don't have any serious catastrophe that actually creates huge losses, usually for non-life sectors. And in terms of liquidity, as I mentioned, there are high levels of assets actually is in cash and deposits. Liquidity levels is important for non-life sectors, as I mentioned. It is paying claim timely. It is very, very important for non-life sectors. Slightly different from the life insurance company where you can pay claims over a period of time. For non-life insurance claims, sometimes you have to pay as and when it occurs, and that having a good liquidities in the asset portfolio is important factors that we do look at. So to sum up, for the life Malaysia sectors itself, the life, why we have it as stable, because of there's a potential to grow, and also there are recovery demands for investment-linked products itself. Banker assurance continue to be important, and historical years we've seen that operating performance is rather stable. For the non-life sectors, yes, there are operating margin constrained by the tariff structures, as I mentioned. Fire insurance continue to be very profitable. However, we are seeing changes coming this year that the motor tariff rates will be deregulated, but it takes 4 years. The Bank Negara of Malaysia are planning to de-tariff the motor premium rates from this year up to 2016, a 4-year phase period for the Malaysia non-life insurers to gradually de-tariff the motor rates. As you see that in any countries under de-tariffication, such as in India, usually any tariff de-tariffications usually result in pricing competitions. So we see that that could be a challenge for the company, for the Malaysia non-life insurer. However, we mentioned that fire insurance is still under tariff rate itself and still very, very profitable. We have not seen any clear signals from the Bank Negara that fire insurance will be de-tariffed in the near future. But we'll wait and see. So that actually concludes my brief discussion and presentation for China and Malaysia. And the last part is on insurance rating methodology, which I will leave it for your own reading, because there's quite a lot of them. I want to include that parts because all the rating that we assign are based on the way how we rate insurance companies. And in the last part actually covers some of the metrics that we actually associated with different rating level, so that some of the audience might be interested to look at. And as I mentioned, all these reports on the Outlook is available. You can email to me. I'm happy to share it with you. And if you're interested to read our rating methodology, which is 100 over pages, I'm also happy to share it with you. So thank you very much.
Thank you, Jeffrey, for the very insightful and interesting presentation. I'd like to open the floor to questions. If any question from the floor.
Yeah, Jeffrey, thanks for that very interesting presentation. I saw a lot of Chinese names on the on the life in China. How open is the China market for participation by foreign insurers? And as a percentage, how do you see it change over time? Is it a closed market? Is it an open market? And where are we on the timeline as a development?
Yeah.
Thank you.
Thanks for the questions. China had actually opened up a market more than 10 years ago for foreign players based on the JV structure itself. However, there are many restrictions. Although they opened up in 10 years ago, but they only allowed by province, I believe, or by city. So the license are actually assigned, given to the JV for particular cities. That means that, for example, Standard Life, they go into Tianjin and they have a JV there, but they can only do business within Tianjin. They cannot, if they want to move outside Tianjin to other provinces, they need to get a separate license and have to go through the procedure itself. And that applies to all the international players. I think literally every single international player is already in China, but they're all, some of them have a few spots in operating in China, but some of them only have one city. because of that itself, as compared to some of the national players like China Life, Taiping, or CPICs or Ping An, which can operate in all provinces, there are 33 provinces, so they have offices in all the provinces, it's very difficult to actually gain market share. So even after 10 years, we actually seen the market share of foreign players only 1%, and even actually reducing. So some of the players actually give up, actually move out from China itself. But these are all the restrictions. I think the China players want to gradually, the CRRC want gradually to open up the markets because they do not want an influx of foreign players there. But that has been 10 years. And I'm not so positive about foreign players in China because for the 10 years, you see the market share is only 1%, especially for the life sectors itself. The non-life, there are slightly some improvement because the non-life is slightly different. The non-life itself, there are foreign companies or like factories actually manufacture products in like, for example, Japan or Korea. There are factories there where they can actually buy the insurance from the foreign player like Samsung, Fire Marine, or Samsung Life, all this. Whereas for the life sectors, you're actually selling the product to the local people or the citizens there. So the restrictions are much heavier. But even for that matters, the non-life, I think, is still not significantly. I think around 5–6%. But the life sectors is always someone want to focus because the life sectors is, you're talking about personal wealth has grown so much over the last 10 years. However, it's just so difficult to penetrate that market and to do it successfully.
Thank you. Any other question? John?
Jeffrey, Jeffrey, a very interesting talk. Thank you. I'm curious as to why the Malaysian insurers would still offer us at a loss third-party motor insurance. I mean, is that because of the government tariff structure, or what's the outlook for that? I mean, are rates going to increase when the tariffs are taken off?
I think because the third party is by regulations, just like in China, you need to have that because that is if you buy a motor, you have to cover third-party claims just in case. So for what they have is it's currently by tariff. It's still on tariffs itself. The losses is so much itself. So, but they are talking about maybe find a way to mitigate that in terms of maybe forming a fund to mitigate that sort of losses itself, because they know that all the non-life company, Malaysian non-life company, they have to offer that. But luckily, on the fire premium side, they have a fat margin. So that's why they have a tariff rates on all the line of business, including fire. So they are not hesitating to actually remove the tariff. That means they know that the fire insurance that they have margin should be sufficient to mitigate the losses that some of the non-life insurers want to take on, because they have to offer the third-party liability business as part of the motor insurance business as well. So we are seeing that the changes of the tariff for fire premiums is very important, when they will change it, because at this moment, their Bank Negara are still very hesitating to change it because they think this is the only way that other non-life companies will continue to offer the third party. At least they can get the profit from the fire business to offset the losses coming from there.
Thank you.
Any other? Nobody? I have one. Talking about Vietnam, how do you see the market insurance there? The outlook. Just a brief.
So Vietnam, sorry, it's not about this because we don't know.
I know that you
but clearly, based on my understanding, I think the market in Vietnam, in terms of personal wealth, is growing significantly. And I think for the life insurance, they will do very well because of the personal. Whatever countries where we're seeing, when we see that the huge growth in the personal wealth itself, life insurance companies always do it very well. And I believe they also have some foreigners there, but there are some JV restrictions in there. So in terms of, we have not ranked anyone there in Vietnam, but I think that in terms of the growth itself, I think it will be quite significantly. However, whenever they come with high growth, the other thing is whether the solvency margin, how the company need to set aside the reserve and also have some buffer to withstand potential losses. So I can only say that the growth looks very good. However, there are certain underlying in terms of how the solvency margin are measured. whether the company are actually solvent. They could write a lot of new business premium. However, you need to set aside some capital because life insurance premium, you collect the premium, you set aside the reserve, eventually you have to pay out. You're not saying that reserve you set up is yours. So that's why we say value of in-force business is a very good measure because you actually take into consideration the cost of capitals that you need to write that sort of amount of premiums.
Yes.
Yes.
How do you see low inflation rate impact on the earnings, the investment return of the insurance company?
Any particular, in general?
In general, because we come from a high inflation rate era now to the last few years low inflation rate, and high inflation rate have always been helping the insurance industry.
Yeah, I think low inflation rate really depends on which sectors itself. On the non-life sectors, because you have to pay out claims itself. So non-life sectors, when you have a low inflation rate, actually on the claim itself it's okay because your amount you paid are restricted within certain range itself. But on the investment itself, if I look at low inflation rate, usually you assign with high interest rates. So you will see a higher interest rate. That's why we see, so your interest rate will also be low. Low inflation is associated with low interest rate. So that actually have some potential issue on life insurance company because when life insurance company actually operate best under high interest rate, because then you are able to earn higher returns for that. So when your low interest rate, you associate with low inflation associated with low interest rate, that means your bank deposits and all investment return will be gradually lower than what you will ever manage. So they have to manage on the mortality experience itself. That means the underwriting itself. So what we are seeing, like some of the companies under low inflation environments, they're actually selling some of the protection products itself because they know that they're no longer able to generate that kind of high return under high interest rate environment, which is a high inflation environment. So they could only provide back to the fundamental of insurance, that is to cover the death benefits, but to not give you so much element of saving in there. Because sometimes life insurance has a protection element plus some saving based on how well the insurance companies perform. So that element itself will be gradually reduced. So that's why we are seeing that some companies are actually now focused back on the fundamental protection products or health insurance products. That are more a traditional kind of insurance product rather than investment plus saving kind of product we are seeing.
Can you share your outlook for Taiwanese life insurance company?
We didn't include that Taiwanese life in our list, so I'm not in the position. But we have previously published quite a few views about Taiwanese life insurance company, which is not so positive. I would say that the reason being because we also see that various foreigners actually pulling out from Taiwanese life sectors itself. A few things. Taiwanese have been always, I let this gentleman ask you, facing very low interest rate environments. The interest rate had not been going up at all, even the 10 years itself is at a very low level. However, the product offering in Taiwan life insurance, historical reason, have been a very, very high guarantee rate return. That means they offer like 6-7%, whereas the short-term bank deposit only 2%. So we always see that you have this huge amount of negative spread burdens that they have to find ways to actually mitigate that sort of gaps itself. And that's why we're seeing that during the Lehman crisis, they are heavily exposed to structured finance products. Is because a lot of Japanese life insurance companies actually very actively go out to seek for structured products that give them the high yields that they have, which they cannot earn locally. And because of that, the result of Lehman crisis, a lot of Taiwanese life insurance companies actually suffer huge losses. And we actually take some negative rating action during that times on some of the Taiwanese life insurance companies that we have rated. And since then they also have another problem is overseas currency exposure. Again, similar to seeking for high yields, a lot of Taiwanese life companies have around 30% of their assets actually invest outside of Taiwan, but have to get higher returns. But they did not do 100% hedging, because they want to earn the overseas return. So what they do is they do some basket hedging. A basket hedging is partially hedging to try to hedge, use a basket of Asia currency to actually hedge back to the Taiwanese dollars. And again, during last year with the sovereign debt crisis, they were hit again because of their exposure of Taiwan dollars has appreciated that much compared to some of the US dollars or some of the foreign currency assets that they have. So all in all, I have to say I'm not so positive on that, but we have not published anything on that, so I don't want to put a stand on this.
Thank you very much, Jeffrey. Just want to present you a token of appreciation from our association. Thank you to all of you for coming today, and I hope to see you soon in our next event. We'll inform you all.
Would you like to
Yes.
pose for a
Sorry.
Okay,
Let's
thanks.
get the picture. Sorry.
Okay, I'll take one more. Because you are on the
Okay, let's move.
maybe. What about yeah, sorry, sorry. Because of the
All right.